on to the Smart Property Investment Show with your host, Phil Tarrant.
Good, everyone. Thanks for joining us. It is time. We try and do this every single month to do a property update. And if you're new to the Smart Property Investment Show, this is where we go through our portfolio, Smart Property Investments portfolio we've been building for about 6 or 7 years now, and we've been sharing our journey with everyone within Smart Property Investment. That journey being a good journey, sometimes being a challenging journey, but something that we are happy to share and we enjoy sharing just to show the ins and outs, the real world of growing and building a property portfolio. We don't sugarcoat anything. I think that's the right metaphor. We say as it is, and where we do well, we'll show where we do well, and when we don't do well, we'll hopefully let you guys learn from it. But fortunately, we've been able to do most things correctly, and the couple of mistakes we've made haven't been too much of an inhibitor for us. So property update, we normally share this around, and I get a number of people who support us in building this portfolio, your property A team, and we speak about this a lot. These are the people who you should be leaning on to help you not only understand where you're going with property investments, so the goal setting and the strategy to do so, but actually the implementation side of things. A buyer's agent, if you use one, everyone would use an accountant, I imagine, mortgage brokers and other people that can support you as your journey. I think this is the first time we've done this. Normally I keep them separate, so I thought I'd bring them in together today, see how they go. Steve Waters from the Right Property Group and Munzurul Khan from Keshab. How you going, guys?
Very good.
Going well, mate. How are you?
I'm okay, and this will be good because we have Munzurul on the show by himself, and then we have you on the show by yourself, and I think this is the first time we've actually done it all.
I think it might be
all together.
It is indeed.
Which is cool, and you know the whole idea of the property update within the Smart Property Investment Shows is just to show you guys, tell you guys, or let you listen into how we're progressing. So the brief I've given to both Steve and Munzurul is just tell it as it is. You know, it's important that we have nothing to hide with this portfolio. We're happy to share exactly what's going on. And as I mentioned, good and bad. Munzurul, last time you were on, we spoke about where we're heading and some of the pressures that we had in terms of our portfolio. And one of the major things was to try and improve the cash position. This cost us a few bucks to keep this. We're just at the tail end now of doing our FY17 accounts, which, as you all should know, is due in the middle of May. So make sure you got your stuff in order. We have, for once. Going to lodge it on time, I hope, Munzurul, and I wink.
Absolutely.
But it's been a good exercise, and I'm happy to report that our portfolio has grown, and I'm also happy to report that our cash position is it's probably 20-odd% improved from where we were a year prior. The net result is that it's costing us in hard, cold cash $46,000 a year to hold this portfolio. And Munzurul, there's 18 doors to this portfolio, or 17 properties, depending how you slice it. So what's that costing us? A couple of grand a property a year to hold.
That's right. So we look through the portfolio and we say that we've just recently done the 30th of June 2017 as a draft, and roughly it's sort of sitting about 47 grand, 47 grand is the overall. So if we divide that by, say, 17 or 18, it's hardly about a couple of grand, maybe just touch bit more as a pre-tax. That has dropped about 12 grand, 11 grand or so from the prior year. So from a cash flow wise, and then we bring in the tax benefits as well. And tax benefit is that, one is that there is the immediate tax benefit, and number two, I suppose, is the depreciation as well. And when we bring in the immediate tax benefit as well as the depreciation, the figures are significantly better. And if we look back all the way from day one as our inception up until, say, today, over the, say, 7 years, the overall cash flow out of pocket negative cash flow is about 230 odd grand. If we take away all the tax benefits and so forth, it reaches up to all the way to about 120 odd grand. So 120 grand, you divide that by about, say, 17, 18 properties, that's not bad.
Okay. So we've just come out of a pretty good strategy meeting, the three of us, myself, Steve and Munzurul, to talk about what next to the portfolio. And we do this sort of every quarter or so, sometimes independently, sometimes collectively. And I find it to be quite valuable doing it collectively because we all come from different, points. Steve as our buyer's agent / property strategist is probably the best way to put it.
Yep.
Property strategist. You understand our goals. You help, I guess, establish what our goals are and help us realise those goals. And Munzurul, obviously a big part of that as well. So we've just spent a couple of hours talking about what have we got to do. And if you tuned into the last property update on the Smart Property Investment Show, you would have heard when me and Munzurul spoke, one of the biggest opportunities for us to help improve the cash flow situation is to have a look at our mortgage rates. So subsequent to that, we had our mortgage broker on the show, Ross Kane from Aussie out of Parramatta, and I know Ross, you'll be listening to this. There's a process underway right now to fix some stuff and negotiate on some stuff. So that should help us quite a lot to try and improve our cash flow position. But a lot of our discussion today before we come to the show, Steve, was are we comfortable with $46,000 negative or even more? Because I think FY18 Munzurul is probably going to be a little bit more because we've acquired 5 properties during that financial year. But
that's right.
Is it hurting us right now to be carrying $46,000? And yes, it does. But how much is it hurting us to pile in and take a lot of action to try and arrest this negative cash flow? And the conversation we just had was, let's get going. So 46K over 18 odd properties, couple of grand each a year. It's not a huge amount of money, but I prefer that to be neutral, Steve.
Well, 2,000 is still 2,000.
2,000 bucks,
right?
Yeah.
It's a big machine now, and there's a lot of moving parts in the machine, and there's a cost to that as well. So, whilst we now know the numbers, and they're pretty attractive numbers too, especially when we compare it towards the growth that it's had over the last 7 years, different parts of the portfolio. I still think cash flow is king. It always has been, always will be, and we need to mitigate that loss to the best of our ability now. Now, whether that means that we construct a few granny flats, which we've talked about before, sharpen the pencil in terms of interest rates, which Ross has done, it all adds up and it'll hold us in a better position.
So Munzurul mentioned that when you look at the length of time I've had this portfolio, and it has grown over that time, and you guys are in the game every single day, and I think you both agree that it's a pretty good portfolio.
Absolutely.
We've been pretty critical of it, and that's a good thing. We're stress testing it, but it's a good portfolio. Yes, we want to improve it, but a lot of the costs associated with this portfolio, we can't really do much about it, can we, Munzurul? Because of the structure we invest within and land tax, all these sort of things. There's not many mechanisms we have to try and improve the cash flow position other than decreasing mortgages, potentially increasing rents, or potentially acquiring some more properties to help even out or give us a greater cash flow position.
That's right. I suppose the comment which I feel from my point of view as an investor, which are the sort of the matters which are priority to me, right? So cash flow is definitely is one high priority. At the same time, the growth and the potential growth is my high priority. At the same time, is your asset protection is quite important as well. At the same time, your longer term succession planning, retirement planning, distribution planning, all of those things comes into account. And some of those sort of mechanisms are a little bit more pricey than some of the other mechanisms. So we've got a structure where asset protection is very high. We've got a structure where diversification is there, and succession planning, retirement planning, all of those things are in there. The other side of that equation, that the cost is just slightly higher. But again, as an investor, the way I see it is that I take things as a perspective, and the perspective that I sort of say is that I sort of say that how much have we started our entire portfolio, and while Steve, you sort of say about the growth and what is our growth and what's the value that we have at the moment. And based on the some of the statistics and the numbers, your market value seems to be about 7.4-ish, is 7.4 mil overall. And if we sort of say that you started with a certain level of cash contribution initially, and was that about 250?
Yeah, about 250, I think. We ponied up to get going. Yeah.
So if we started at 250, 7.4 is the market value. When we take away all the mortgages against it, our net equity seems to be about 2.4, 2.49. And if we divide that over, say, 7 years as a compounding return, it's still very high. It's about 39% or so. Now, what's interesting is that one of the previous sort of the podcasts that we had, and I suggested that the return was even higher as a compounding rate. While the 39% is brilliant, it's slightly lower. And that is one of the things which will happen over a period of time. Your compounding return, it cannot stay that significantly high. But nonetheless, 39% return over 7 years, I'll take it.
So when you look at this portfolio now, Steve, I think there's 9 odd properties in New South Wales. And by properties, we mean a door where we generate rent from it. So there's, for example, in our property in Port Kembla, it's a 2 townhouses, 1 block. So it's 2 doors.
One title, 2 doors. Yeah.
Yep. So there's 9 properties in New South Wales, 8 properties in Queensland, and 1 in Victoria. So there's a level of diversification there in terms of states that we're in, also the type of assets we're in. So there's some townhouses, some units, and there's by and large mainly houses on freehold land. 39%, that's been really good. But when you look at our portfolio, we've done a spate of buying recently, predominantly all in Queensland. But most of the growth in our portfolio has come from New South Wales. So I'd like to say that we bought in the right places at the right time. Obviously, no help from you.
None whatsoever.
That was all you. So 39% is a good number, right? And compounding growth from an initial investment of 250, and that's just really it's a bit of a hypothetical because we've pulled that money back out anyway. It's back in our pocket, so it's really no investment for that. But we'll say as it is, 39%. Have we just been really lucky, Steve, that we got into Sydney at the right time because we haven't yet seen the growth yet from these Queensland properties, or are we going to look back in 5 years' time and say, geez, weren't we smart getting into Queensland when we did, because nothing happened for a little while, but then it just rocketed and we've seen the growth that we got in Sydney.
It's a good question, and it's something that we get asked a lot. Look, there was no doubt that a little bit of luck on your shoulders happened because you decided to get into property at a time that perhaps the Sydney market or the New South Wales market had bottomed out and it was starting to find its feet and go forward. So a little bit of luck there is one side of it, but I'd look at it a little differently, saying where you actually activated something, you did something, you got into the market. Now, whilst most of the growth in the portfolio is a direct result of New South Wales, it's about controlling the opportunity. You just happen to have all the proceeds of that opportunity come in a very short period of time. There was no wait for you. And Sydney has outperformed the averages, so to speak, and there'll be a period of no growth. That's how we do get our averages. But investing is about controlling the opportunity. So it's looking forward and around the corner, over the hill, to where all the fundamentals are, and setting yourself up to take advantage of the growth that's going to come. And you do that via being in the game, but also via the cash flow, which is what we've done for the last 4 hours, is looking how we're going to adjust that cash flow and give a better way to control the portfolio going forward. So
one of the arguments, Munzurul, would be we've had this great growth in Sydney, and some of these properties, many of these properties within Sydney, and you're all familiar with this, I hope. If you're not, go and check out smartpropertyinvestment.com.au where our assets sit, but they're all in affordable belts. Western Sydney, Southwest Sydney, your Campbelltowns, your Blacktowns, Mount Druitt's, etc. Penrith. Some of these properties have more than doubled in value. So, we've been fortunate to be in a market at a point in time when that happens. Is there an argument to say, well, our money's done our work in those markets, is it a time to sell down and that's going to help improve your cash position? Is that a fair statement?
Yeah, good question.
I'm actually looking really forward to Munzurul's answer.
Here you go.
Knowing who he is.
Hates selling property.
It's a very good question. Couple of comments which I say. Well, first comment which I say is that the difference in between the timing and the time in the market. I think this is the point which I want to say, that you've done very well, Steve, from your point of view, and Phil, from your point of view as well, that while you sort of timed it very well, both in New South Wales and arguably in Queensland as well, is that it's also being the time in the market as well. So we can be a little bit critical, saying that, well, Queensland properties haven't really grown as much as the New South Wales. Out of that, your 2.49, 193 seems to be in growth in Queensland, 130 seems to be growth in Victoria, and all the rest of it came in New South Wales. But the other side of the equation is that the Queenslands are very recent purchase, as early as, say, October last year, is that when you bought that block of units. So we need to give it the due amount of the time. And the other comment which I want to also say is that when you purchase a particular property, there are additional costs. So you've got all of those incidental costs, stamp duty, solicitor's cost, and so forth. So arguably in day one, you actually start with a negative equity. So you need to fulfill that negative equity, and then you go into the growth. So the question is that, well, has New South Wales reached its peak? And if New South Wales reached its peak, do we take some of the profit as such? No one answer, right? One side of the view is that, well, yes, we can, and yes, we can sell it. And once we do sell it, if we do recapitalize that into the sort of the right market in the longer period of time, that perhaps whether we would be better off. The other side of the equation, one sort of asked the question that, well, selling has got a whole bunch of cost. So you've got, one is the selling cost, two is the capital gain tax cost, three is the repurchase cost. So you need to fulfill all of those three costs: selling, capital gain, repurchase, and only then you are break even, and then you are making the profit. Then the next comment which I sort of say is that what's the time frame of our investment? Is it 5 years? Is it 7 years? Is it one cycle? Is it multiple cycle as such? So yes, New South Wales properties arguably has it reached its peak, but if we look forward in about, say, 7 years time, 10 years time, do we still see that the history is repeating itself? Do we still see the similar level of growth?
My view of it is, yes, we could take, and people say take the money off the table when you can. That's great. But so we liquidated some of these properties and took the profit out of it and recapitalised it elsewhere, i.e. another market, which wouldn't be Sydney,
Yep.
maybe a Queensland or even in WA or some of the other states. It'd be pretty hard to replace these Sydney assets again, because to get back into the Sydney market, it's going to be very, very difficult.
And I think that's the question. I think that's the big $64 million decision to make. Sydney it's Sydney. It's not regional, Victoria or Queensland or wherever else it is. It's Sydney. It's a world-class city. Arguably so is Melbourne. And to replace what you're selling in a city like that we have here, there's a bigger cost involved. Now, there are some exceptions to the rule. If you had a property in Sydney, only because we're talking about that was just making survivability all but impossible, then you'd have to seriously consider it. But as Mun said, there's so much more than just selling a property. There's CGT, there's exit fees in terms of your loan perhaps, there's also agents' cost. So if you are contemplating actually selling any asset, no matter where it is, have a look at the net result.
There's also the buying costs. Really.
And the buying costs. And if that's what you're choosing to do and move your money on elsewhere, is what is that net position in terms of cash left over or capital left over? Because there's always a cost somewhere.
And the low built is the comment that you sort of say that perhaps whether we buy it or whether we bought it in a little bit lower socioeconomy, that by itself, I sort of say that, well, the definition of that sort of changes over a period of time. I mean, there's a point of time that people would look into red fund and say, no one goes anywhere near to red fund. And now we look into red fund and we say, well, it's quite cafe culture.
Yeah. And affordable. It's at the end of the day, all these areas in your portfolio follow the affordable corridors throughout the different states. And a really good example is what Munz just said. Redfern at one stage was probably a little undesirable, and it was certainly affordable compared to other places. If we fast forward to today and look at, say, Cambridge Park in your portfolio, it wasn't too long ago that, and this is, don't take me out of context here, but it wasn't too long ago that perhaps it wasn't at the top of the list for people to purchase as a first homeowner scenario. And now it very much is, purely because of affordability. And as the homeowners come into these types of areas, the position of the area changes, the streetscape changes. It gets this whole new fresh look about it, because at the end of the day, nobody looks after a property better than the person who owns it and who's living in it. And as a result of that, we start to see the growth that's happened, of course. Now, there's been a few other factors as well, such as the price of money, consumer confidence, all that sort of lovely stuff. But at the end of the day, all the fundamentals are in the correct area, and it suited your price point in terms of the buying price, and it also suited the cash flow position, which was part of the initial strategy to begin with as well.
I think we need to be quite conscious of using the term affordable, because we're talking about the Sydney market right now, and the property having Cambridge Park, it's a great property. We renovated it. Very family orientated area. A stone's throw from Kingswood or Penrith. It's still under $650,000. That's a lot of money, right? And people say affordable. A lot of people say unaffordable. I'm climbing on my soapbox as you say that, and I'm just going to step down. Look at him.
Look, that's a whole different podcast.
Yeah.
At the end of the day.
But we say the affordable areas, but we're saying these are the areas that your average Australian family will be buying property now and definitely into the future. So for me, they're great places to be. This is going to be there's going to be greater demand for these type of products than what there is demand for, and we're recording this looking out over Neutral Bay at the moment. It's going to be greater demand those properties out in West than what it will be here at Neutral Bay, purely because of the number of properties, but also the ability of people to build a home, build a family, build a life in these highly attractive areas of Sydney, which are only going to get better and better.
But and probably to add to that, affordability is just not just the buy-in price as well, or the cost to purchase. It's also about how much it is to rent, because not everybody is going to own property. There are going to be people that just rent, and they might be a rent-vestor, as an example.
And see, if you look through the demography as such, you would say that the demography by itself changes over a period of time, right? We might say Campbelltown, we might say St Mary's is sort of quite a bit far away from the Sydney CBD as such. Over a period of time is that there would be no such thing as a Sydney CBD. There would be multiple CBD. Yeah. So you would have your Sydney CBD, you would have your Parramatta CBD, you'd have your Chatswood CBD, you'd have your
CBD.
Blacktown CBD, you'd have your Penrith CBD and Campbelltown, then our line of thinking would be at that stage is that, well, Campbelltown is about, say, 42, 45 kilometres away from CBD. We'll sort of say that, well, this is this particular street, which is only about 2 kilometres away from Campbelltown CBD. And that's sort of the future. And if we look through some of the sort of I suppose some of the nations, which are some of the cities which are a little bit more advanced, whether we look through US, whether we look through Europe, or whether we look through Japan as an example, there is no one CBD as such. So my personal view is that what I've seen with my client group is that very often when there is a bit of profit and when it's being sold, that's sort of the immediate gratification, so to speak. Yes, there is quite a bit of profit. There's a bit of tax. There is a bit of this, but we still get the gratification. But very often with the same sort of the investors, they sort of look back and sort of say that, well, we sold it at a point of time, but if we were to hold on to it, is that is the additional level of the growth that we have given away. That is the additional opportunity gain. So my best case scenario would be is that we hold it as much as we can, as long as we can, and then at the same time we expand.
So we're rationalising, patting ourselves on the back for all the smart decisions we've made to build this portfolio, and 39% compounding return on your initial sort of cash in, even though it's come out. But you know, in anyone's book, and you guys do this all day, it's a pretty good result, right? It's a pretty good result.
It's a brilliant result, and I think there's a couple of points that I want to really sort of clarify. And it's a brilliant result. Clarify in the sense that you started with 250 odd grand cash, and then eventually what he did is that you've actually taken out that 250 odd grand cash. So effectively the entire return of your portfolio is $2.49 million portfolio. One may argue that this entire return has sort of been generated sort of with no sort of a net impact on a cash flow side of it. The second point, which I want to also clarify, is that while we sort of say that, well, the cash flow is sort of sitting about 46 negative, the prior year was about 56, 57 grand as such, but your cash flow is a complete all-inclusive of your cost, right? It's 100% of your purchase price and the leverage associated to it, 100% of your renovation cost and all the incidental costs, right? So we've done in the most conservative of the conservative manner. So on that basis...
So we haven't tried to paint a really nice picture. That's the real numbers.
These are the real numbers.
That's as simple and clear as it gets, and it's actually quite entertaining to watch Munzurul talk about this. He's moving around on the spot. It's very unusual as an accountant, but it's but the numbers.
What a personality!
Sorry, accountant. That's what I was actually waiting to see how long it'd take you to start the sledge, but not very long. But numbers are numbers at the end of the day, and the numbers are very good. And as you say, we can all sit around here and pat ourselves on the back and so on and so forth. But it's about what we do from here going forward. Buying the property or actually creating the portfolio to begin with is actually relatively simple. It's about controlling it and giving yourself longevity. And part of that is the cash flow. And we did talk about earlier on for a couple of hours about some of the ways that we can arrest some of the cash flow negativity shortfall, and we'll implement that over the next probably 6 months.
The thing is that during our conversation before we come on air, my question to you guys was, okay, let's not do anything from here on in. Let's not touch it. Let's not do any refinancing. Let's not buy anything. Let's just manage it well. So make sure we keep our interest rates competitive and keep our rents competitive. What would happen? You know, would this portfolio ever become cash positive? And Munzurul, to your point, it would take at least a cycle, maybe two, for it to at least hit parity, right? Cash in, cash out, and with the cost to hold it.
Yeah, and it does, because you sort of expect, depending on where the rent cycle is, rents to sort of increase anywhere between, say, 3 to 5%, maybe touch a bit higher or so, right? So it does take time in terms of the rents to sort of increase. One may argue that some of the incidental costs sort of slightly increase, whether it's a council rate, water rate as such, but not in the same rate as the rent sort of increase. Then I suppose the other sort of the big is the interest rate side of it, and what would be the rate of the interest rate over a period of time. And I suppose one of the comment that we sort of discussed is that if we look through the historical rate of what the interest rate is, yes, we are at sort of at the lower end of the cycle as such. But I remember in terms of my sort of the first investment journey when I started back in 1999, and my interest rate was around that sort of 5.9, close to about 6%, a little bit higher than what it is, but it was not significantly higher. So yes, it takes time, and it will take time if we leave that on its natural course. Okay,
so it's spoken about, yes, it's a good portfolio and it's performing well, and yes, we're all very smart and intelligent people. That's great. Big tick. I want you to get... Which, and
not all of us.
That's me being... Yeah, I wish this was on video because you'd actually, it's being quite self-depreciating. But anyway, but you know the way I'm wired. So, Munzurul, I don't want to talk about the good stuff. I want to talk about the bad stuff. And the bad stuff and understanding the bad stuff is where you can get ahead in life. And I'm personally quite a reflective person. I always try and improve what I'm doing or how I deal with people or whatever it is. And I'm okay for constructive, negative, constructive criticism. So over to you. Give me a hard time about my portfolio. What it can be my personal approach to it, or how I run it, or the decisions I've made. Give me something good, Munzurul.
Steve and I, we are mates and would like to stay as mates. Look, a whole lot of, there are many positive things, as he said, and we can speak about the whole lot of sort of positive things. So any of those comments which I'll make, these are more sort of my wish list. These are sort of my ultimate wish list.
So you don't have any fundamental problem with how me personally I'm running this portfolio?
No, mate. I think it's a brilliant portfolio because, yes, there is a little bit of cash flow sort of a shortfall as it is being expected, but over, say, 7 years of $2.5 million sort of a net growth of 39%, we'll take it at any day.
I'm going to ask you the same question. I imagine you're going to be a lot more forthcoming than Munzurul. He's being very diplomatic here.
I'm just standing back saying, pick me.
So your wish list is the way you would frame, you could do this better. Okay, let's talk about your wish list.
Couple of things in my wish list. In my wish list, ideally, every single property should have some level of potential level of manufactured growth potential. Every single property. So whether we can subdivide, whether we can build a granny flat, whether we can sort of build a duplex or so, ideally. In my wish list, ideally, over a period of time, we would have the right level of sort of the diversification. And we do, to a great extent. We do have it in New South Wales. We do have it in Queensland. We've got a little bit in Victoria as such, but we're still sort of New South Wales and in Queensland. So I suppose if I look through some of the numbers, is that while we sort of say about 7 million plus is the asset value, 4.9 million is sort of sitting in New South Wales, and in Queensland market sitting hardly about $2 million as such. So if we're sort of saying 4.9 million of my asset is not expected to grow that much, only 2 million is expected to grow over the next 5 to 7 years. I raised the question that where is the growth sort of coming through? Yes, we've done well in the last 7 years or so, but how would we do in the next sort of 7 years as such? So ideally, every single property, whether there's a development potential, whether we do the development or not, having that option to me is a sellable asset. Yeah. So that's sort of my wish list. And then we sort of look through and we sort of say that, well, if we look back, have we utilized all the potential of the individual properties to their full value? So we spoke a couple of properties that we can easily build a granny flat, whether that's our aptitude. But that sort of granny flat, there is quite a bit of cash flow as such. So it's done well, whether the efficiency level being utilized as much as we could, both from a diversification point of view, as well as the manufactured growth, and bit from a cash flow.
Okay. Fair. I agree with it all. Steve, you can get personal.
I owe you a bit, don't I?
Yeah. What do I got to do better? What can we collectively, but I do better?
This is all about you.
It is all about me. It's always about me.
Look, I think, and I say this,
and you can put this as what's management street, like a shit sandwich, right? This is really good, but this is shit, but this is good. However you want to package this, I'm okay with it.
It's like a pat on the back, a bash in the head, isn't it? Yeah. Look, and I say this in all truthfulness, Phil has one of the best spreadsheets I've seen in terms of accountability, because for the listener, he does account for everything. Whilst a lot of investors tend to sugarcoat their figures in terms of, well, I'll just miss this cost out, such as land tax or my accounting fees or my very nominal buyer's agent fees. It's Phil accounts for it 100%, and so therefore he has a true reflection of his cash position and his net wealth position at any one time. That's really good. So that's as good as it gets.
Okay.
The only thing, there's a lot more good. The only thing that I'd probably say that not just you, but as we all could do better, and I'm talking every investor, is perhaps to be a little bit more proactive around the figures. Whilst it's all good to do the figures and have the figures and look at the figures, but what are you going to do about them? So we talked about the cash position as we have, so doing something about it. Knowing that we have to do something about it versus doing something is two totally different things. Now, we're all guilty of that. And I mentioned earlier on about, well, if it's not hurting too bad, it's not hurting enough. And it doesn't make you do something. And once again, we're all in that boat. But other than that, I think you've done really, really well. You've been prepared for the most when you've needed to be, and you've scrambled and hustled when you had to. And that's part of being an investor in any asset class, is actually being reactive to the opportunity. Some would say, well, being prepared for the opportunity, but I'm a bit more, that's good, but you need to react to it as well, and you've done that really, really well. There are some purchases that the novice investor may not have touched because it required renovations to the far left, and there's been bigger purchases such as a block of units or 5 different doors, that there's a lot of pressure when you're doing something like that. In that particular deal, there was a lot of back and forth, and we lost it, we got it, we lost it, we may have lost it again. So how you've handled that between your ears, I think, has been really, really well. But I'd just like to see the cash flow position tightened up a little bit, and that's going to be via some granny flats perhaps, which we might talk about next time, and also some interest rates, which you're doing
you guys
today.
get us on granny flats, and Ross, who you're tuning in here, I think everyone's pushing it back your way.
No.
We gave him a bit of a hard time last time, and he's a very reactive Ross. He's a very good broker.
Brilliant.
Ross, it was not me. It was...
it was me, was it?
Yeah, it was you.
Was it?
This is all about you.
It is all about me.
It's
I'm going to stay out of this.
No, Ross has been, and we'll get you back on, Ross. Give me a call, mate, when you listen to this. But I know there's a lot of things in the works right now to go through this whole process of what mortgages, and there's paperwork on my desk actually, what gets fixed, what we can negotiate on, how long we fix it for, why we fix it, who we fix it with, and then I guess applied against, look at our portfolio. And the conversation we just had was, if we fix these interest rates, is that going to stop us from doing anything which is potentially equity manufacturing orientated?
Yeah, pre-planning goes a long way. And just on the whole interest rate thing, sometimes as an investor you take the product that you can get, and sometimes that does come with a cost, being the price of the money, the mortgage, just to get across the line, and then you adjust accordingly later, which is what you're doing. But there is a lot of planning that goes into the portfolio. So we've sat for the last 3 hours crunching numbers, looking backwards and forwards and sideways. And as your portfolio gets larger, and I'm talking about anybody's here, you really should get your subject matter experts all together around the table at any time, so that everybody's on the same page, everybody's heading in the same direction, but we're all knowing intimately the numbers of the portfolio. Because at the end of the day, this is a multi-million-dollar business for any investor, and you should take it seriously accordingly. Yeah,
it is. You got to maintain the health of it at any given time. And to your point, and Munzurul would have said it but he's too polite. I could sometimes be not as hands-on as what I should be or could be with this particular portfolio, purely because my time is just taken elsewhere, right? So there's been points with this portfolio where we haven't done anything for a year and a half, where you haven't bought anything, and then over this current financial year that we're in right now, I think we've bought 6 properties or so.
But that's okay. You don't have to buy all the time. Consolidating, catching your breath,
time is
sitting
great
on your hands is just as important. Sometimes you'll make more money by doing nothing than you will by purchasing.
The problem, I can see a lot of investors fall into this part. It's nice to do the nice things, the exciting things. It's a lot of running a property portfolio, which sucks.
It's certainly not passive.
No, it's not. A lot of the admin around it, and I know you guys have much larger portfolios than I do, and you've got some pretty streamlined systems now for you to be able to, from an executive of your portfolio, to actually understand what's going on within it. And that's the way I view our portfolio. Give me the key numbers, give me the headline, benchmark numbers, let me know if there's a problem, whether or not this needs my time, or it's just operational business as usual stuff, which is a bit of a headache that someone else can deal with, look after. And that's what I try and do these days, is concentrate on the value adding stuff and mess around checking statements and whether or not I've received the right amount of rent versus any costs that have come out because I've had to replace a hot water system. Someone else can tick that off, right? So it's, what's the most dollar productive activities you can undertake as an investor? And if you only got one property, do it all yourself so you know what's going on.
I think you should
2 properties,
do it all.
3 properties, 4 properties, do it all yourself. But it's going to get to a point where you got to start prioritising your time and making sure we can add value. And I guess, and I'd like to think that sitting down with you guys for 2-3 hours to run through this sort of strategic direction of this portfolio for the next sort of, at least next quarter, 6 months, is a good use of my time. But what do you do? And I speak about it a lot, getting your A team, your advisors all together to chat about it. What do you do if they don't get on? You guys get on well, and you have a particular role to play. Steve Munzurul has a particular role to play. Ross has a particular role to play, and you all have a good relationship, but you're coming at it from different angles, and you all have a different a different objective, I guess, or a different master in terms of what role you're supposed to be doing. What do you do if you guys don't get on?
We and this is not Munz or Ross, because clearly we all do get on. You know, but let's say there's a different accountant or broker or solicitor in the mix, or whatever it may be.
Yeah. Or you get conflicting advice.
Conflicting advice is not very often. However, it does happen. But in terms of getting on, we're just very clear with Mr. and Mrs. Client that all egos should be left at the door. This is for your benefit, and everybody needs to be on the same page. So you need to select your team around you and make sure that they all do get on. If they don't get on, well, there is going to be conflicting advice. There's going to be conflicting procedures, so to speak. So it's a must that at the very least they get on or respect each other's advice, so that there's the benefit for yourself as a client.
So, Munzurul, should your advisors, your guys in your corner, support people, march to the beat of your drum, or should you work within the way that they typically do stuff because they do it every single day? That's probably the best way to do it. If that makes sense?
Yeah. Absolutely. I think it's the expert in the right field, into the field that you are, right? And the practical experience is quite important as well, right? So there's all those different investments, sort of the vehicle as such. So you can't just have an expert who is sort of quite a bit on shares and managed funds, as an example, is sort of proposing in terms of the property side of it. The practical experience isn't there, and the vice versa as such. So I agree with Steve's comment that the group needs to sort of work together as such. Absolutely, the group needs to. I think where it is important is that you mind to stay open. I like where it is a sort of a mutual, sort of a self-reflecting and sort of a challenging as such. And the reason why it works very well with Steve and Ross and with ourselves is that one is that we've got mutual respect for each one of us. And at the same time, we're not afraid to take a sort of a feedback. And as long as there is a logic with that feedback, we learn and we develop and grow. It's like a board of directors, right? So your investment property is your sort of investment vehicle. It's your business vehicle as such, right? So when you go into the board of directors, the board of directors could be the most brilliant board of directors, but if they're not speaking to each other, you're really not getting a lot of value out of them, right? So it is important. The other comment which I was sort of going to make with one of your previous sort of comment is that in terms of your investment property and how do you sort of see the investment property, what do you do, what value proposition that you do? I consider each property on its own merit as both a balance sheet as well as a profit and loss approach. So when I sort of purchase a particular property, when I sort of evaluate that property over a period of time, I sort of see that, well, this small business unit, so to speak, which is the investment property as such, how much value it has increased, how much cash flow it is costing us, right? So if there is a particular property, the previous question that do we sell any property, if there is no growth potential, and at the same time it's costing us quite a bit from a cash flow, that's a property that we do consider whether we do. If there are growth potential, we go.
Okay, so just on that basis, and I like the analogy of running your portfolio as a business, and you have different product lines within that business and their individual properties, right? Some perform better than others, some cost money, some add money, et cetera, et cetera. So you talk about a balance sheet, and for our listeners that might not be that sophisticated when it comes to this sort of terminology, I recommend go and learn about it. It's pretty easy. There's plenty of reading. But you talk about balance sheet, you talk about P&L. So balance sheet being the asset.
That's right.
And the P&L being how much is it essentially costing you to hold it. So cash in, cash out, what's the result? That's
right. So you've got about $7.5 million, the overall portfolio, and your net asset has increased about 2.49 is the net asset increase, which is brilliant on its own. Then what we do is that ideally we go through and analyze each property. How much out of that 2.49 of your property 1 and property 2 and property 3 and property 10 and property 18 it has done? And more importantly, what are the prospect in future with property 1 and property 2 and property 3? Similarly, on a cash flow side of it, your overall cash flow could be, say, 46 grand as an example is negative. But that's a combination of 18 properties and not in a linear manner, right? Some properties are costing you a little bit more. Some properties are costing you a little bit less. If a particular property is costing you a little bit more, then there needs to be a strong justification why we're holding it. And we're holding it mainly because primarily we may say that, well, it's the capital growth that we're considering. So if we use the analogy as an example of a business, a whole large business, the business by itself is profitable, but it doesn't necessarily mean that all the ingredients, all the individual component of the business are profitable. There could be a component of it which is a loss-making entity, but the overall is profitable. So it's about the information and it's about knowing the detail of the information.
That's good. And Steve, what's next? We're going to have to wrap this up. We've been going for a while. What do we do? So we can fix the cash flow situation. So we're going through the process now of looking at all of our interest rates, and there's a couple of things available to us there, and we'll touch base in a couple of weeks to let you know how we're going with that process. There's potential for some granny flats to try and inject some additional cash flow into the portfolio. Obviously, that will have a capital cost that we'll need to finance in some way or another, whether it's through cash or through refinancing. And if refinancing it, it's going to detrimental to our cash flow position. So there's a couple of moving parts there. But what else do we do now? We're not going to stop. So what do we go and buy? How do we buy it?
Being very general, and it's not meant to sound that way, but we're going to be very opportunistic. So we'll be looking for something that we can add value to. And furthermore, from what Mun said earlier on, something that is instant equity for whatever the reason may be. Might be renovation. Something that has perhaps some development potential. Now, when we talk about development, we've got to be very careful on exactly what that means. And it's about more so controlling the opportunity, having the choice whether to do it. So we're looking for something that is ahead of the curve, maybe a different market for some diversification, something that we can add value to whilst at the same time creating cash flow, so that we're not going to go backwards, preferably at all, in terms of the cash flow position, but also giving us opportunities in terms of development, multiple incomes, whatever it may be, because you're now at a level where the portfolio is quite sophisticated, and we need to step up in terms of the types of deals that we do now. And a really good example of that was, when we've already done that, would be the block of units at Launton.
Yeah,
there is that was the next level stuff. So block 5, individual titles, and multiple strategies that we could carry out on that as time goes on. So that sort of stuff we'll be looking for.
Yeah, Muns agree?
Yeah, absolutely. And just with the numbers again, when we did the numbers, all three of us, we did the numbers just at a high level in terms of your interest rate, I suppose negotiation fixing, as well as potentially one or two of the granny flats that we sort of considered. We spoke anywhere between say 30 to 35,000 of sort of additional sort of a cash flow. And then when we sort of say 46 grand, and when we take away about 30, 35, all on a sudden the holding cost is absolutely nominal.
And in closing, because I know we've got to wrap up, I really want to reiterate just how important this is to the listener about getting together with your subject matter experts, if you have them, and if you don't, just taking the time out of your life to sit down and go through the numbers and review your portfolio as often as you can. We like to do it quarterly with clients because it is that important. It is amazing that what you can't see about your own numbers when you're heavily involved. So having someone look at it from the outside in will often give you new light and new direction on that portfolio. So really, really important, which is why I say the money's in the back end of the portfolio, not so much the purchasing it.
And I agree with that. I always enjoy catching up with you guys because it just helps me, I guess, refocus my attention on property and remind me why I'm doing it. And often it just gets sort of put down quite far down the list of things I need to get done. So it's always good to reconnect and reignite with your portfolio and get a little bit of, I guess, add to the rigour of how you assess it, look at it, analyse it, your feeling and sentiments towards it, but often also just to give you some tasks to undertake to get going again. And I'm very task orientated, so plenty we can do from here. But it's good summary, I think. Good summary, Munzurul.
Thank you.
Thanks for on a personal level, I appreciate you guys helping me out with this because, it's great that we can actually share this story with property investors right across Australia. And, my view of this is that if it sounds too hard and you don't understand it or it's all too overly complicated, you're probably not doing the sort of stuff that you should be doing. Property investment is simple if you're connected and you don't overcomplicate it. So, got to be happy with it and comfortable with it. And if it's too much for you, speak to the right people to help you out. And just a reminder also, I don't really like to do disclaimers and all this sort of stuff, but the stuff we're spoken about today is specific to our portfolio. So none of this is to be deemed advice. You need to make sure you speak to the right person in terms of your own portfolio. But hopefully some of the ideas and concepts and terminology that we've spoken about today or looked at can help you shape the way in which you view your portfolio. So guys, thanks so much for your time. Munzurul Khan from Keshab.
Thank you very much.
Steve Waters from Right Property Group. Let's do it again in about a couple of months' time, I think. See how we're going.
Absolutely.
Get some of these runs on the board. We cover our portfolio quite a lot on smartpropertyinvestment.com.au. Just click on the Our Portfolio tab and you can read all the stuff we're doing and listen to other podcasts that we have done on it, plus some articles when we're buying some YouTube stuff. So go and enjoy it. If you've got any questions at all about the portfolio, you can email myself or the team, editor at smartpropertyinvestment.com.au. And if there's anything specific for Munzurul and Steve, I'll make sure I flick it over or get their interpretation of it and get back to you. We're happy to do, and we do Q&As around the portfolio as well. So any questions, I'm happy to answer them live on air, and so we can share your thoughts or sentiments with the rest of the community of the Smart Property Investment Show. If you're not subscribing yet, so you're the first to know what's going on in property investment, smartpropertyinvestment.com.au/subscribe. Or if you'd like to get your info from social media, just search for Smart Property HQ. You can find us, like us, love us. And as always, guys, I appreciate those reviews coming through from iTunes or wherever you're listening to this particular podcast. It's more than just myself here behind the show. There's a big team of very talented producers and other guys who are helping to make sure we get the voice out or the word out to Australia's property investors. So reviews, 5 stars, please, if you don't mind. If you can find a time, do it. And if you want to leave a quick note, please do. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.